Today I want to talk about mortgages. Recent statistics tell us that there's €80 billion in debt on mortgages, home loans in Ireland. That's about covering 700,000 homes, which means an average mortgage per home of about €144,000. That being said, last year the average mortgage taken out was €335,000. So the 144, of course, takes into account lots of old mortgages that are nearly repaid. What I want to talk about today is whether you should repay the mortgage early. It's a question we get asked over and over again through direct messages and other avenues, and we thought that today we'd give you the definitive answer. And before I get into numbers, I'll show you some numbers as we go through this today. But before I do, let's look at the broad pros and the broad cons, because there's two sides to every coin, of paying off your mortgage early. The pros are a guaranteed return, because you don't pay tax on saving money. The other pro is that that return is tax-free. There's the peace of mind. Priceless, one could say. 80% of people who have no mortgage feel much happier than those others with mortgages. There is the increased cash flow earlier, because as soon as you've paid off the mortgage, the money you were paying on the mortgage is now available for lifestyle. And that means financial freedom that we talk about being available that much earlier. And there's minimal risk, because the returns are all but guaranteed. Of course, interest rate risk exists, and if you're on a variable rate, they can change either up or down. But there's very little risk when you decide to repay a mortgage early or accelerate payments. But as I say, every coin has an opposite side. What are the cons? The cons include the opportunity cost. What else could you have done with the money? Could you have made more money from an investment return? Could you have got tax relief on that money by investing in a certain manner? The cons are the time value of money, as counterintuitive as it feels, guys. The longer you repay the capital on a mortgage over, the cheaper it is. If you think about paying $10,000 a year in capital over 20 years, the $10,000 you pay in year 20 hasn't got the same value as the $10,000 you paid in year 1. Because time value of money has eroded. Inflation has eroded its value. And I suppose the last con is diversification. If you invest the money instead of accelerating the property payments, you're diversifying away from property into other investment assets. So let's look at an example. What I want to use here is a €500,000 mortgage over 20 years at a current interest rate of 3.7%. That's the average variable rate on the market today. This mortgage costs you €2,985 per month to repay, or €716,000 over the 20 years. Let's say you have €100,000 to invest. And you want to look at, well, let's say I invest that €100,000 in my mortgage. What happens then is, of course, the outstanding balance drops to €400,000. But if you continue to pay the €2,985, which you're used to paying, you repay that mortgage in 14 and a half years, not 20 years, and you save yourself around €90,000 to €91,000. That's an IRR, effectively on the 100,000, of 4.5% per annum. Not bad, eh? And remember, as I said, an IRR that's tax-free. However, let's say instead of doing that, you decided to invest the 100,000. And here we're going to invest it in the S&P 500. Why? Because it's the most popular stock market index. And that index, over the last 15 years, has done 11.8% a year. So let's say it does the same in the next 15 years. The return, the growth brings that 100,000 to 503,970. But of course you still have a mortgage. What's outstanding on the mortgage at that time is €160,000. So to be fair, we need to take that away, don't we? So the net return is 343,970. You are 343,970 better off in this example by investing in the S&P 500 than investing in your mortgage. Of course, people will say, but isn't there tax on this? Well, that depends on how you make the investment. If that investment was through a pension fund, the answer is no, there is no tax on this. If that investment was from somebody who lived in a jurisdiction where they don't pay capital gains tax, the answer is no. But even if I apply full capital gains tax to that, the growth, the net return is still 227,000 more. So, and I'll do a number in a minute which shows you a monthly payment and how that differs. But without being a clairvoyant, I can predict to you the monthly payment, the investment will always beat it because the returns are bigger. Even as I say, if maximum taxes apply, it will beat it. But it doesn't deal with, does it, the fact that being mortgage-free can be priceless. So it's not, deciding or not to invest in your mortgage is much more an emotional decision than it is a financial one. Because if I simply do these numbers over and over again, no matter what number I use, as long as I'm using a 4.5% return on the investment in the mortgage and an 11.8% a year return on the investment in the S&P 500, of course investing is always going to deliver more. So purely financially, investing delivers more. But of course there's risk, isn't there? I said up here, there's no risk up here. There is risk down here. We don't know that the market will do 11.8%, even though it has done it before. Even though in the 50-odd years you look at it, every 15 years it has a positive return. That doesn't guarantee the future. But as I often say to people, if you and I are going to predict that the S&P 500 in the next 15 years won't do roughly what it's done in the last 15, you and I have to predict the end of capitalism. We have to predict that no new inventions will be made, that mergers and acquisitions will disappear altogether, that nobody will want to buy new stuff. I can't make that prediction. I can't believe in that. That's a future where we're all living in a hole in the ground out the back eating beans, waiting for the sky to clear. So purely from an investment point of view, as I say, as long as these numbers apply, investment will always win out. The question is, do you have the stomach for it? Do you have the appetite for the risk that it involves? And will your family support you? Let me interrupt this podcast for a moment. Do you know how to create wealth? Do you know how to limit your taxation? Do you know how to protect that wealth when you do create it? Well, if the answer is no, our masterclass is for you. Over 12 modules and 36 videos, I will personally teach you how to create wealth, how to minimize your taxations, how to protect that wealth when you create it. Check out the link below, and now back to the podcast. So let's give you a second example. This time I want to look at monthly repayments and increasing those rather than a lump sum. Not everybody has a lump sum to pay off their mortgage. But let's say we'll use the same mortgage, so it's $500,000 over 20 years, 3.7%. We know that costs $2,985 a month, and we know it costs $716,000 over the 20 years. Now, if you add $500 a month to this, so you start to pay $3,485 per month. Same interest rate. The loan repays in 16 years' time. 4 years early. Those 4 years means you don't pay out €143,000. That's the 2,985 by 12 by 4 that you would have paid out had you not accelerated the loan. So the profit on the 500 a month is that, and that's an IRR of 4.46%. So it's a little bit more profitable than the lump sum method in this example. But of course, there's always the alternative, isn't there? The alternative is, well, what if I invested the money? If you invest 500 per month and you get the same 11.8% S&P 500 return for the last 15 years, the value of that 500 a month in 16 years' time is €285,624. Now, as before, you still have a mortgage outstanding here because you haven't accelerated the mortgage, you've invested instead. And the outstanding mortgage at that stage is €130,950. Broadly speaking, the net return is €154,000. That's how much you've made extra over and above repaying the loan. So as I predicted when we looked at the lump sum numbers, the investment numbers are always going to be better because they assume a far higher return. Of course they're going to be better. But as I also said, the question is, do you have the appetite for risk? Will it satisfy your better half or your joint mortgage holder? Is there a priceless nature to being mortgage free, which we talked about at the very start? 80% of people who have no mortgage are happier than the rest of us. So that can be priceless. It's never going to show up in an arithmetic. But the question for you is, can you live with it? What are your priorities? And of course, as I'll talk about in a minute, you could do both, couldn't you? You could do some mortgage acceleration and some investment, depending on, as I said, your attitude and appetite for risk. So, should you accelerate your loan repayments on your home mortgage? As I've shown you, it depends, doesn't it, on the assumptions you make. It depends on the risk appetite you have. It depends on your co-mortgage holder and what he or she might want. The assumptions, for example, earlier I assumed interest rates on the mortgage would stay as they are. I'm long enough in the tooth to remember I had a home loan in the early 1980s where the interest rate was 19% plus. So interest rate assumption, while we're on a much more even keel these days, we're making that assumption that they continue. We're making the assumption the S&P 500 continues to do over the next 15 years what it did over the last 15. And as I said earlier, making those assumptions will always mean that the investment option outpaces the repayment option. But it's about your priorities too. Being debt-free, being mortgage-free, it can be a major boost to one's personal happiness. And that is priceless. So me running any sort of numbers doesn't necessarily convince you. The question is, what is your priority? If your priority is using your capital and income to generate the very best financial outcome possible, with a willingness to take risk to achieve that goal, then investing will always be a better option on paper. If your priority is to be debt-free, is to have the money you're paying on your mortgage available to spend down the shops, then paying off the mortgage will be the best option. But as I say, it's up to you to choose, and it's up to you to run the numbers. I've earlier explained that we have run numbers using certain assumptions. But you maybe test those assumptions. What happens if interest rates go up? What happens if mortgage rates go down? What happens if the S&P 500 does better than 11.8? What happens if it does worse than 11.8? And it won't surprise regular listeners to hear me say that if you can't do that number crunching yourself, get somebody else to do it for you. That's where impartial financial advisors come into their own. The opportunity costs of paying off your mortgage include the investment I've illustrated, includes pension contributions which are fully tax deductible, includes EIS opportunities which are higher risk but also fully tax deductible. It includes money markets, it includes private equity, it includes bonds and loan notes, government bonds. All of these things are something different you could do with the money rather than pay off the loan. And all come with varying degrees of risk and varying degrees of potential reward. Your mortgage is likely the largest single debt you will ever have. Your home is likely the largest, most valuable asset you will ever have. And because of that, these decisions are very, very important indeed. They are not to be made listening to headlines. They are not to be made because interest rates are X today or Y tomorrow. They're to be made testing the waters, testing the market. And that's what the financial planners can do for you. That's what a truly impartial person, not somebody who's selling you the mortgage, or not a bank manager who wants to de-risk his bank book, a truly impartial advisor. So, should you repay your mortgage? That depends on your priority. That depends on the numbers you run. And that depends on the assumptions being made.